Hello! Today is Thursday, December 21st, and we are on day one of the Breaking into Wall Street Challenge. Today is going to be my first official journal entry upload where I share with you guys some of my learnings and takeaways from the financial literature and the financial knowledge that I've been looking into today. A few things that I want to note down before I get started. Firstly is that I literally am studying all of this by myself, so there's probably a lot of room for error, but I'm just sharing with you some of the things that I am learning and absorbing within the literature that I read. So if there is anything that does need some sort of a correction, please feel free to let me know down in the comments below. I'm genuinely here to learn. The second thing that I want to note is that I'm still basically unpacking myself. So this is a very, very rushed video. So I just want to point that out. By no means am I going to be able to record a study montage or anything cool of that sort. So unfortunately, no study montage today, nothing fancy, but I just want to record a quick journal entry for YouTube. The finance topic that I dove into was equity and valuation. The first key term that I want to note down is what market cap really means. So essentially, it's asking you the question, how much is a company really worth? What is the equity valuation or the market capitalization? These are all interchangeable terms. So the way we calculate it is the share price multiplied by the number of shares outstanding. So for example, if you had 1 million shares outstanding and each share went for a price of $10 per share, then you would have a market cap of $10 million. Now, given this fact though, it's very, very easy to know this calculation, but what's a little bit less clear is what happens if you're unable to find out the number of shares that exist. And this is due to a factor called diluted shares, or the number of diluted shares outstanding. It's very hard to figure out exactly how many shares you have at a given point because of the fact that some shares haven't necessarily been made. I want to introduce you this concept called actual price versus a price tag. So if you think about Pokemon cards, I might only be willing to buy a little set of Pokemon cards for $10 or $5 or whatever, but inside of that Pokemon card booster pack, I might find a super, super rare card that could retail for $100 if it's in good condition, heck, even $1,000, right? So we don't necessarily know, inside of the pack, you bear on a lot of the responsibilities, just in the same way a company would bear on excess cash, or the same way the company would bear on pension liability that they have to pay out to their employees into the future. In the same way you can bear excess cash or other assets that can save you money into the future, you can also bear a rare Pokemon card or a card that's worth basically nothing. You have to look at the actual price that's being sold for versus the inside value of that company or that Pokemon card packet. So I want to basically share with you how this really works. A price a company might be sold for a different price than what it's actually worth. So for instance, as I said earlier, a company might have excess assets, excess cash, or other sorts of pension funds that they have to pay out into the future. This is basically known as what's called enterprise value. The calculation that you have to do is basically you take the equity value or the market cap, and then you add on all of the debt that they have in the company and debt structures. So as I said, pensions or even options and stuff that they have to bear. So debt obligations, and then you less out the amount of cash that you have, even the illiquid cash things you have to also less out. So the cash or asset obligations that you have, things that save money, you also have to less that out. This is what gives you your enterprise value. So in other words, it means that you add anything that you pay for, and then you subtract anything else out that you don't necessarily pay for. So there's this concept in finance called dilutive securities. So initially, a dilutive security might not be a common stock, but it always gives the shareholder the mechanism to obtain more common stock. And so this can be done in a few ways, which we'll get into. The most common way that shareholders use to do this is via option. Some other ways that they might be able to do so is via convertible bonds, convertible common stocks, warrants, which are pretty similar to options, restricted stock units, and performance shares. Feel free to do your own research on what each of those are, but for now I'm just going to share with you what common stocks are. It's something that's considered a dilutive security if after you convert the security into a common stock, the EPS or earnings per share, which is the net income divided by the number of outstanding shares for existing shareholders, decreases. what's different from anti-dilutive securities is that, like, for example, if you decrease the amount of shares or even increase the EPS for every single share, then that's going to be considered an anti-dilutive security. Now, moving on, I think it's very, very important to note what options are. So there's two types of options. There's call options and there's put options. Now, I like to think of call options as like buying stuff. So like traditionally, you call somebody, like if you ever watch Wolf of Wall Street, to like issue you the stock after you call them, right? You call to buy shares and you put to sell your shares. But for the purpose of valuing a company, I'm just gonna focus on call options. So specifically for these call options, companies will issue this option, which is usually for their employees, to be able to buy more shares of the company at a specific price, which is also known as the exercise or strike price. And basically what happens is the company will issue newly generated shares in return so that the employee can exercise their options and purchase these shares at a price usually below what is the market value. And so if they're able to earn money, we call this in the money. And if they're not earning money, we call this out of the money. So for example, if you can buy the share on the stock market for $2, but then your option allows you to buy it for $200, why would you use the option to pay $200 when you can just buy on stock for $2? But like if the stock is valued at, let's say, $200, but then they give you the option to buy it at $2, then you're basically profiting $198, right? So that's what's called in the money, which is profitable. Now, the exercise price, right, as I said earlier, is the price at which you can buy this share. So the price at which you can use your option. For example, if a share is worth $10 and then the company allows you the option to buy this share at, let's say, $1, then your exercise price is $1 up until that certain time. And so even though the employee may do so, they can also hold on to it depending on their future perception of value. So for example, if like that $10 share is going to jump to $100 into the near future, then you might want to hold on to that option so you can exercise it for a better profit or a better gain in the future. One thing to note is that this has a potential to increase at literally any point in time once these options are used to increase the number of shares, which therefore increases the amount of shares outstanding. And because you increase this amount of shares, then it's harder to find the company's valuation as a person doing like valuation, right? So essentially, it's worth calculating and worth figuring out how much you're really paying versus what it's really worth. So it's important to calculate the diluted equity values since dilutive securities get cashed out upon acquisition. And if you don't calculate it or if you don't account for it, you underestimate the actual company value when you're acquiring. So there are cases then where it makes more sense to use one or the other. So you might ask, okay, well, Oscar, when do you use enterprise value versus when do you use equity value? I like to think of it as like a net income basis or like a cash flow statement. So before you pay out your cash flow, right, including your interest income, such as like when you lend money or like you borrow money from somebody, you have to pay the interest, right? So before you pay this interest out, such as dividends or whatever, equity value should be used. If this cash doesn't include like your interest income or like your dividends that are paid out for debt and equity investors, then you should use your enterprise value instead. So for instance, like after interest, right, your debt is paid off, which means that debt investors have no claim, so no real contractual claim, and the rest essentially goes to the equity investors. So if you think about like contractual versus residual claim, feel free to do your research. That's the way I like to think of it. So for instance, if you have like revenue or EBIT, which is earnings before interest and taxes, or EBITDA, however you pronounce that, is earnings before interest, taxes, depreciation and amortization. Feel free to do your own research again. You want to use enterprise value, while net income or EPS or earnings per share or free cash flow to equity, you use equity value. The next concept that I want to note is debt to equity ratio. So it's essentially asking a question, how much debt does a company have to its assets? And basically this metric is to use to gauge a company's financial leverage. So the way you find this is by dividing the total liabilities by shareholder equity or like the amount of money raised. The last two things that I want to note are market value versus book value and like the valuation multiple, because I feel like these are concepts that get mentioned and thrown around a lot, and I did a little bit of research outside of my reading. So firstly, on market value versus book value, I think market value is basically called equity value, right? Shareholders' equity then should just be book value, or net asset value, or assets less your liabilities. I like to think of it as like empirical accounting value and not necessarily like the value of which it's traded at. So just note, market value is the price at which the shares are traded at on the market, how much people are paying each other for the stocks, whereas like the shareholders' value or book value is like how much it's actually worth on paper. Like a company's market value is going to be a lot higher or relatively higher than their book value. And the reason for that is because like if there's something like a goodwill, right? Or you might have like a patent, or you have like some kind of an intangible good that doesn't necessarily have a price on it, people are willing to pay more because that's an asset that you can't associate a name to it. If you kind of think, there's usually some sort of a strict reason as to like why a company is going to be implicitly worth more when they do liquidate. So like the best example is like a brand reputation, right? Like how do you know how much the name McDonald's is worth, right? You don't really necessarily know that. So you kind of just have to go by an implicit value. The last thing then is like a valuation multiple. So basically these are ratios to report on data to make it more comparable and clear. And what this does is it helps evaluate financial metrics in terms of another factor. Okay, that was a mouthful. I'm very thirsty, but that is it for day one. These are some of the things that I've been looking into and reading, and this is a summary of my notes. In the future, if the series does go well and you would like to see my notes, please let me know down in the comments below, and I'm more than happy to share them. I'm also very, very curious as to like what you think. Is there anything I missed? Because I'd really love to learn, and I'd really love to have the opportunity to engage with all of you. Especially because I know literally nothing and I'm starting from like scratch. So if there's something that I missed, please let me know, and I'm more than happy to like, do a little bit more research myself. But thank you so much for watching this video. I think this was a pretty successful day one, and I really hope that you'll stick with me tomorrow, and I will see you in day two for my next topic, my next journey on finance. Cool. Thank you guys so much for watching. I'll see you next time. Bye.